Welcome to the Corporate Files Lab. This is Case File, #005. Today is Intelligence Briefing. The Apple crack, the $1 trillion siege of a digital empire. We are analyzing the state of play as of January 2026.
The mission for our operatives this cycle is clear. We must move past the glossy quarterly earnings reports and understand the fundamental shift in risk exposure for Apple Inc.
It's a huge shift. This is no longer the predictable, fortress-like platform we analyzed just, 2 years ago?
Not at all. We are witnessing a perfect storm, a convergence of systemic pressures. You have legal, geopolitical, and operational fronts all closing in at once. It's fundamentally altered the company's risk profile.
So we've moved from a pillar of institutional certainty to a position of inherent instability. The old rules of engagement are obsolete.
They are.
Okay, let's unpack this.
Yeah.
When we talk about instability, we're not just talking about temporary market noise, are we? We're talking about permanent structural damage.
Precisely. The stability that underpin Apple's premium valuation is visibly evaporating. And for you, our subscribers, understanding the mechanisms of this fragility is paramount.
Because information is the only currency.
Yeah.
So let's start by establishing the current snapshot. Where do things stand right now?
Well, we look at the immediate status quo as of January 14th, 2026. Apple's market capitalization is at $3.85 trillion. Or, to be exact, $320.87 billion.
Still one of the world's most valuable entities, obviously, but that number doesn't tell the whole story.
No, the immediate trajectory is a significant red flag. We've seen a clear deceleration.
Specifically, how does that look on the 30-day chart?
Over the past 30 days, market capitalization has decreased by a notable 4.27%.
Okay.
But more crucially, if you look broader, the last 12 months show a decrease of 4.38%. This isn't a blip. This signals a deep structural reevaluation by institutional investors.
They're digesting the new reality.
They are. The reality that the formerly immutable growth story, the one powered by the services division, is now variable. It's under attack. That confidence that priced Apple as a perpetually expanding entity is eroding with every percentage point we lose.
And that structural attack, it begins and ends with the legal system. The core thesis that defined Apple's dominance, the walled garden, is now under active judicial dismantling. So let's begin our deep dive right there. The permanent legal fracture that will define the next decade of Apple's revenue model.
The foundational threat to Apple's entire financial structure, it doesn't originate from a competing piece of hardware. It's not a rival operating system. It's the outcome of the protracted 5-year Epic Games litigation.
It was never just about Fortnite.
Never. The real target was Apple's highly profitable services division, specifically the anti-steering provision and, of course, the 15% to 30% revenue cut on in-app purchases, the IAP.
Which is the lifeblood of that division. Let's just contextualize that for a moment. The services division is so critical because it carries these extremely high gross margins, much higher than hardware.
Oh, absolutely. It was the financial engine that justified Apple's massive valuation. It offered predictable, recurring revenue that wasn't subject to the seasonality of the iPhone or, commodity price fluctuations.
So any assault on the IAP mechanism is really an assault on the company's entire valuation thesis.
It is, and that assault began in earnest with what we call Phase 1, the 2021 injunction. The initial ruling by Judge Yvonne Gonzalez-Rogers in September 2021 was often misreported.
Right, because Apple technically won on 9 of the 10 counts. They dodged the big one, being declared a pure monopoly.
Exactly. That was a partial victory. But the critical loss was tied to California's unfair competition law.
So what did that mean specifically?
Well, the court found that Apple's anti-steering policies, the rule that forbade developers from even telling customers they could buy things cheaper outside the App Store and prevented them from including a direct link, were anti-competitive.
So the judge just struck it down.
She permanently prohibited Apple from stopping developers from linking users to external payment systems. That, right there, was the first significant crack in the wall.
And here's where it gets really interesting, because Apple didn't just accept this. They executed what we call aggressive non-compliance, which led directly to Phase 2, the April 2025 contempt ruling.
Right. After the Supreme Court denied Apple's final appeals in January 2024, they were forced to comply. So they introduced a new link-out policy.
But this policy was Let's be honest, it was engineered to be intentionally prohibitive.
Absolutely. They immediately imposed a staggering 27% commission on any external purchases that were conducted through these new links.
And that wasn't the only maneuver. The genius of their strategy, or perhaps the hubris, was the introduction of immense friction.
Yes, scare
The
screens.
scare screens, highly discouraging warnings to users about vague security and privacy risks outside the App Store environment, basically suggesting these external purchases were inherently unsafe. They even restricted the design of the link itself, burying it or making it difficult to use. Right.
It was a calculated risk, a workaround designed to ensure no major developer, like Epic, could profitably bypass the 30% App Store fee.
Because why would you? If you have to pay 27% plus processing fees and absorb all that friction cost, the whole exercise becomes pointless.
Exactly. And the judicial response was swift and absolute. On April 30th, 2025, Judge Rogers found Apple in civil contempt for willfully violating the injunction.
And she didn't mince words.
No, the court didn't just disagree with the fee. The strategy itself, the 27% fee plus the friction, was characterized by the court as a sham designed explicitly to preserve billions in revenue while just giving the appearance of compliance.
So this contempt finding had profound and immediate implications.
It was a judicial sledgehammer. The key mandate from that April 2025 ruling banned Apple from imposing any commission or fee on purchases made outside the app.
Any at all.
Any. And furthermore, it prohibited restrictions on the style, placement, or language of external links outside of a strictly neutral message that Apple couldn't interfere with.
And the immediate visible proof of that victory was the forced return of Fortnite to the U.S. App Store in May 2025. That finally ended Epic's 5-year exile.
And it signaled to every other developer that the legal landscape had fundamentally shifted in their favor.
However, the dismantling wasn't fully finalized until Phase 3, and this is where a critical element of compromise was introduced.
That's right. The acknowledgement of Apple's intellectual property rights. On December 11th, 2025, the Ninth Circuit Court of Appeals weighed in on the contempt finding. They affirmed the contempt, agreeing the 27% fee was prohibitive.
The proof being that nobody used it.
Correct. No major developer was willing to adopt it, which proved its anti-competitive intent. But, and this is the key vulnerability we need to track, they partially reversed the district court's total ban on commissions.
Why? What was the logic there?
The Ninth Circuit held that Apple is entitled to some compensation for the use of its intellectual property. This acknowledgement creates the current uncertainty we're now in.
So they're saying Apple still provides the infrastructure, the security, the APIs, the developer tools.
The whole ecosystem. The court acknowledged that getting zero revenue on transactions that still benefit from that IP might constitute an unlawful seizure of value.
So the case was remanded. It was sent back down to Judge Rogers.
Back to Judge Rogers to determine what constitutes a non-prohibitive reasonable commission. And this, right here, takes the services division, which was built on rigid, predictable, high-margin revenue, and converts its core mechanism into a variable, judicially monitored rate.
The predictability is permanently gone.
And this structural vulnerability is the biggest takeaway for our operatives. The financial modeling here is stark. If Judge Rogers determines that reasonable compensation is set low, say, in the 10% to 12% range instead of the existing 30%.
What's the damage?
Analysts estimate a potential $15 billion to $20 billion annual hit to Apple's high-margin services revenue.
$15 to $20 billion annually. That's not market noise. That is a hole in the P&L that share buybacks cannot possibly fill forever, which immediately spills over into our next segment, the $1 trillion volatility cycle.
Right. The structural legal collapse we just detailed created a synchronized financial crisis. The moment of reckoning came in the spring of 2025. It wasn't just the contempt finding in April. It was the convergence of that ruling with new U.S. tariff announcements.
Which we will detail later.
And that combination caused an immediate and violent financial shockwave. It crystallized into what we call the April 2025 liquidity crisis.
Define that volatility for us with specificity. What happened in those crucial 6 days?
On April 2, 2025, before the contempt ruling was delivered and before the full tariff regime was absorbed, the stock, AAPL, was trading at a high of $223.13.
Okay.
By April 8, just 6 trading days later, the stock had collapsed to a trough of $171.83. This was rapid price discovery as the market absorbed the implications of the judicial and geopolitical fronts closing in simultaneously.
And the sheer scale of market cap destruction in that period is staggering. We use the
Oh.
figure $1 trillion because it encapsulates the total loss from the late 2025 peak valuation to the lowest points of crisis. But that immediate shock was massive.
It was. Our sources indicate this period resulted in the largest 30-day market cap destruction in the history of the S&P 500. It erased an estimated $750 billion in value. Just gone.
What was the core fear driving that?
It was the compression of the PE multiple, the price-to-earnings multiple. It's how investors value a company relative to its profits, and a high PE signifies high institutional certainty and expected future growth.
And Apple, specifically the services division, it always enjoyed a massive PE premium.
Absolutely. The institutional consensus was that the services division, protected by that impenetrable walled garden, deserved a premium multiple sometimes upwards of 35 times trailing earnings.
Because the revenue was deemed perpetual and predictable.
Exactly. The contempt ruling shattered that confidence. Investors feared the legal dismantling would permanently compress this multiple, maybe having it to a valuation more typical of a slower-growing industrial hardware manufacturer. That fear, the repricing of certainty, is what evaporated $750 billion overnight.
So how did Apple's command structure respond? How did management execute triage and arrest this decline? You can't just passively absorb that.
Management executed an aggressive stabilization strategy. It was centered on massive capital allocation, the buyback countermeasure. In May 2025, immediately following the collapse, Apple expanded its share buyback program by a staggering $100 billion.
$100 billion. And they ultimately spent most of it.
They spent $90.7 billion on buybacks in fiscal 2025 alone.
Explain the mechanism of the buyback for our operatives. Why is returning capital the triage for a structural problem like this?
It's a mechanism to artificially stabilize or even inflate earnings per share, the EPS. By repurchasing shares, the total number of shares outstanding decreases.
So if profits stay the same, you divide them by a smaller number and the EPS goes up.
Exactly. It creates an appearance of continued growth for investors who are focused on per-share metrics. And it helps mitigate the market's reaction to flagging gross revenue in critical regions like China and, of course, the new uncertainty in services.
It's a financial band-aid, a controlled demolition strategy designed to prevent complete panic while the company tries to address its core structural challenges. But the volatility continues.
It does. We saw a temporary recovery. The stock price hit an all-time closing high of $286.19 on December 10, 2025. That was likely driven by optimism around the holiday sales cycle and a general market rebound.
But since the Ninth Circuit ruling was digested, the ruling that confirmed the reasonable fee mandate remained, the stock has retreated significantly.
And as of our current briefing on January 14, 2026, the market cap is down 6.58% from that December peak. This retreat signals that the market views the services revenue stream as unreliable. It's now subject to the whims of a judge, not the absolute control of the executive team.
The buybacks are crucial, but they cannot restore the lost institutional certainty.
And they do nothing to address the operational and cost pressures on the other half of the business, hardware. Which brings us to the geopolitical risks.
Right. Moving now from the courtroom to the volatile landscape of international trade. Apple is caught squarely in the crosshairs of Trade War 2.0. The 2025-2026 U.S. tariff regime imposes direct, measurable costs on Apple's high-volume hardware business. We call it the geopolitical tax.
And this is not abstract trade friction. This is a measurable contraction of gross margin. We can analyze the direct cost warning Apple management provided. They projected an estimated $900 million in higher costs from tariffs.
In a single quarter.
In a single quarter, Q2 of fiscal year 2025. That's nearly $1 billion disappearing from the bottom line in 90 days. That translates directly into a gross margin contraction of maybe 1.5% on hardware.
And that cost is never simply absorbed. It's immediately passed to the consumer, which damages the price elasticity of the iPhone at a critical moment.
Exactly. The new tariffs, including specific semiconductor tariffs, they forced Apple to introduce a predicted $100 MSRP hike for the iPhone 17 base models.
So this is the strategic tightrope walk. They have to raise prices because of U.S. policy, which hurts sales volume, while at the same time facing intense pricing and performance pressure from local competitors in their most critical market.
China. That dual pressure is immensely damaging.
Let's discuss Apple's countermaneuver here, the American manufacturing shield. This is a massive political effort, right? It's intended to mitigate future tariff risks.
It's political insurance. The commitment is enormous. A $600 billion investment pledge to the U.S. economy. This includes expanding specialized facilities like Corning's Kentucky plant for cover glass and the crucial financial backing of the TSMC Arizona chip partnership.
So this is a strategic political move. It's not about efficiency. It's about securing future tariff exemptions.
Or at least preferential regulatory treatment by localizing some high-value component production within the U.S.
Yet even with that shield, the headwinds in the China market itself are perhaps more damaging than the tariffs. We're seeing a profound China market retrenchment, a collapse in consumer loyalty.
The revenue metrics reflect this. Revenue from China fell 2.3% in the fiscal second quarter, ending March 29, 2025. It missed analyst estimates.
Which is an ominous trend for what was once the company's most reliable, high-growth engine.
And it's being fueled by intense domestic competition. This is where the Huawei renaissance comes into sharp focus.
They reclaimed the top spot.
They did. Huawei successfully reclaimed the top spot in the Chinese smartphone market in 2025, securing 16.4% of full-year market share, narrowly beating Apple's 16.2%.
How did they pull this off, despite years of crippling U.S. sanctions?
Two factors: domestic technical superiority and escalating patriotic consumer sentiment. Huawei achieved a critical breakthrough with its proprietary Kirin 9030 domestic chipset.
Right, so sanctions choked off their access to foreign chips, but the 9030 neutralized Apple's premium technical edge in the local market. It proved a Chinese competitor could deliver a high-performance product again.
So the performance gap that used to justify the premium price just disappeared, and Chinese consumers had a high-quality, patriotic alternative. Then you layer on the structural disadvantage created by local policy, the pricing floor.
This is insidious. The Chinese government, trying to stimulate domestic consumption in 2025, implemented consumption subsidies.
But these subsidies applied only to phones priced under 6,000 yuan. That's roughly $820.
Which conveniently excludes the vast majority of Apple's premium, high-profit margin models.
Precisely. Apple is excluded from this massive government stimulus, which immediately spurs local rivals. Xiaomi, for instance, saw 40% year-over-year growth in early 2025, directly capitalizing on these very subsidies. Apple is literally fighting a subsidized, state-backed cartel on its home turf.
And compounding this problem, and crucial for the premium brand positioning, is the AI gap.
A massive competitive lag. Apple is still awaiting Beijing's approval to deploy its core generative AI features in China. In the modern smartphone market, AI integration defines premium.
And their rivals already have it.
Rivals like Huawei and Xiaomi have already integrated advanced, locally approved AI capabilities. So the latest iPhone appears technologically stagnant to sophisticated Chinese consumers who prioritize cutting-edge functionality. Without AI differentiation, that $100 tariff-driven price hike becomes impossible to justify.
Finally, let's look at the logistical nightmare that is the boomerang supply chain. The U.S. is imposing these massive tariffs up to 145% on Chinese goods. But the components are still getting through.
They're being rerouted. It's called transshipment. Chinese exporters are aggressively rerouting components through Southeast Asia and Europe to skirt the penalties.
It's a logistical shell game.
It is. Components originating in mainland China are labeled as originating from Vietnam or Malaysia after minimal assembly or packaging changes. It's designed to dodge duties.
But that shell game comes at a massive cost that Apple eventually shoulders, eroding hardware margins even further.
It adds substantial logistical costs and time. Our data shows logistical costs increasing anywhere from 10% to 46% simply due to the added complexity. This doesn't represent the dissolution of Chinese dominance. It represents a costly reorganization of it.
And Apple ultimately pays the price through delays, higher complexity, and margin erosion. The tariffs are a tax on the entire supply chain, not just the final import.
Exactly.
So the immediate reaction to these compounding geopolitical risks in China is the accelerated pivot to India. The goal is strategic decoupling, but the operational realities on the ground present a series of severe challenges. The India friction.
The diversification mandate Apple has set is extremely aggressive, which reflects the urgency of the China risk. The goal is to shift 32% of global iPhone manufacturing volume and 26% of the total production value to India by the 2026-27 fiscal year.
That's a total manufacturing value exceeding $34 billion. This pivot is necessary, but the execution is fraught with operational difficulty.
Well, we must first acknowledge the success metrics. The scale-up has been impressive. The 2025 milestone saw iPhone production value reach a record $22 billion. Crucially, exports crossed $23 billion in 2025. That's an 85% jump over the previous year.
So they're making progress.
By the end of FY25, India is expected to contribute 17 to 18% of global iPhone production volume. That validates the strategic goal. But for our operatives, the key risks lie in the friction encountered on the factory floor.
Let's address the most critical bottleneck that debunks the myth of an easy replacement for China: the yield gap, technical inefficiency.
The disparity is staggering. It reflects the immaturity of the Indian ecosystem compared to China's 2 decades of state-backed manufacturing maturity. Chinese factories typically achieve production yield rates of 98% or higher. They are nearly perfect.
And in contrast,
Major Indian facilities were reporting yield rates of approximately 50% in late 2025.
50%. That means statistically, if an operative were on the floor, they would see every other unit rejected.
Exactly. Apple was forced to reject almost half the production from one major Indian partner because it failed to meet their stringent quality standards. The implication is profound. This severe inefficiency effectively negates the cost advantage of lower Indian wages.
You save $1 on labor, but you waste 50 cents on scrap components.
Plus, the cost of rework and the logistical delays inherent in correcting massive quality issues. The cost of failure is eroding the benefit of the shift.
And the operational friction extends beyond technical expertise into fundamental differences in labor structure. Let's compare the China model to the requirements imposed by Indian labor law.
In China, the hyper-efficient model relies on intense equipment utilization. They use 2 grueling 12-hour shifts to keep assembly lines running 204/7. It's relentless, but highly efficient from a capital standpoint.
But the Indian labor model mandates a different approach.
Indian labor laws mandate 3 8-hour shifts. While this is beneficial for worker welfare, it introduces significant operational challenges. To get the same 24-hour equipment utilization as China, partners must hire a significantly larger workforce.
About 50% more personnel.
Right. And then you have to manage the complexity of training, shift overlaps, and quality control across 3 distinct teams instead of 2. The human capital burden increases administrative and training costs dramatically.
Which leads directly to friction number 3, the skills bottleneck. We're talking about massive capital pouring in, but the investment in human capital is lagging far behind.
There is a distinct lack of trained shop floor operators and specialized process engineers. This is critical for modern manufacturing. For instance, there's a severe shortage of technicians who can operate and maintain highly specialized systems like automated optical inspection or AOI machines.
And without that advanced expertise, you fall back on manual inspection, which directly contributes to those terrible 50% yield numbers. It's a vicious cycle.
And this dependency gap highlights the grim reality of the situation. India remains primarily a final assembly hub. The hundreds of complex, high-value components, the microcircuits, custom displays, sensors, chipsets, they must still rely on the massive, mature, and efficient Chinese supply chain.
Often rerouted through transshipment, as we discussed. So, in effect, India is mitigating geopolitical risk, but it is not replacing the high-yield engine room of Apple's manufacturing dominance.
Not at all. A true resilient decoupling, where India can provide the complete component ecosystem, is simply not achievable in this current product cycle.
So we have dissected the 3 major systemic threats. Now we must synthesize them. The risk is compounding. The crunch point Apple faces is this convergence of financial risk services, margin compression, and operational risk hardware margin erosion from tariffs and the India friction.
Which brings us back to the existential question. Can Apple survive as a service company if its hardware hegemony is crumbling? The services division, currently reporting strong revenue growth, up 12% to $26.7 billion, is nevertheless under an existential threat regarding its reliability.
Because that 12% growth is built on the historical foundation of the predictable 30% IAP fee. That foundation has been legally destroyed.
It's gone. The predictable 30% rent is replaced by the uncertainty of a reasonable, judicially determined fee. The stock market is violently re-rating this risk, which we saw in April 2025. It's not about today's revenue. It's about the vulnerability of tomorrow's margins.
Meanwhile, the hardware side is showing concerning signs of stagnation precisely when these legal and geopolitical costs are peaking. We've seen a lack of significantly differentiated features in recent iPhones, like the iPhone 16, compared to models from 2023.
This innovation lag, coupled with the delayed deployment of critical AI features, especially in China, suggests hardware stagnation is coinciding perfectly with the imposition of geopolitical tariffs and the costly, inefficient pivot to India. It's a fatal synergy of events.
Think about the consumer proposition. The $100 MSRP hike on the iPhone 17, driven by the geopolitical tax, makes an already marginal upgrade significantly more expensive. This occurs exactly when Huawei and Xiaomi are offering sophisticated, subsidized, and AI-integrated alternatives in the largest consumer market on Earth.
You're asking consumers to pay more for less certainty of innovation.
Exactly. This brings us to the core shift that defines this deep dive. Apple has transitioned from a technology pure play, judged on product design, to a geopolitical actor. Its future is now dictated as much by international law and trade policy as it is by its industrial design team.
Its destiny hinges on courtrooms in San Francisco, boardrooms in New Delhi, and regulatory approvals in Beijing.
So what does this structural shift mean for our operatives? The $1 trillion loss in 2025 was not merely a fleeting market correction. It was a permanent, structural reevaluation of how much value the market assigns to the walled garden once the walls show fundamental, permanent cracks.
The institutional certainty is over. The predictable 30% rent is gone, replaced by judicial variables. The cheap, high-yield manufacturing engine is under threat, replaced by costly, inefficient relocation. The crucial Chinese market is subsidizing patriotic rivals. Apple is no longer an exception to the gravitational forces of geopolitics and regulation.
The immediate threat, as we have analyzed, remains the reasonable fee determined by Judge Rogers. That dictates the future margins of the services division.
But the greater challenge is this. Can Apple innovate fast enough in generative AI and hardware development to justify its premium pricing globally? Or will the crushing costs imposed by legal defeat and geopolitical warfare permanently compress its growth trajectory into that of a traditional, slower-growing, margin-squeezed hardware manufacturer? That is the real uncertainty for the next 5 years.
Case file closed. The bigger the empire, the harder the fall. Stay ahead of the curve. New intelligence available every Saturday.
You've been listening to Corporate Files Lab, briefings on AI, business, and geopolitics. Subscribe to our channel for more briefings like this one and leave a comment.